Hello, everyone. It is February the 12th, and it's 3:38 p.m. Pacific time, 6:38 p.m. Eastern time. In today's video, I'm going to be talking about some important data sets and then also go over the SPX 10K challenge campaign and then give maybe look at a couple of charts that I might be interested in trading, but like I told everybody else in the Discord room, I'm 100% focused on the SPX 0 to DTE 10K challenge. So I am, even though it is kind of painful to not be trading some of the high flyers like Tesla and Nvidia, in all honesty, I'm not really looking to trade those unless they get above like $500. Okay, per like the underlying is over 500. I just don't think that the value of trading them, those instruments, those option instruments, when there's so much FUD, makes any sense at the underlying price of under $300. It just doesn't make any sense to me. Of course, you can make money, like you can make money in any market. It's just, I think there's more value in the SPX, and it's a challenge that I am currently in the progress in. So let's first look at the S&P E-mini futures. So we had like a potential breakout here, and we know there's a gap at 4,225 that they left open right here. Okay, and we get a little bit of a double top, and then it starts to roll over to retest the 21-day moving average. And at this point, the futures have opened up. We've got a bearish engulfing candle early at the start, and then maybe we get like a double bottom here to retest at 21. Um, if this is going to go up and and you're going to look for a strategy to trade that gap at 4,225, which I think is probably going to get filled on a Friday or maybe on a CPI. There's CPI next this week. I would wait till it gets above that 6-day moving average. Right now, the trend has rolled over from bullish to bearish. It looks like we might be going through this consolidating period, trading above the 21. That's the orange line right there. Okay, so that orange line is at 4,067.88. If you can see that wick right there, that's a magic mic. So there's plenty of reasons for this price to slide all the way down to the bottom of that wick, and then also slide down a lot of these other wicks down to the 50-day moving average at 4,000. So a psychological target of 4,000 is now probable and always possible. So yeah, I don't think like swinging anything here makes the most sense if you're going long. I think what you want to do is try to see how Monday's candle right here closes. If it closes as doji, then there might be a pop into CPI and two. I can't remember when is the CPI. Let's take a look here. So CPI comes out on right. So Tuesday. So that's a pretty big day, and it can come in bullish or bearish. You can see that also the cumulative delta on the volume chart here is kind of reverted back to the mean of that Bollinger Band. And yes, of course, there's plenty of room all the way down to reach the lower end of that Bollinger Band. But right now, I think the support here is at that mean level at this this volume amount, which is just nothing. You're not going to remember that. So, like in terms of the pattern here, we've got the gap up here, and I think there's plenty of gaps below. Let's just take a look at the gaps. Right, so I mean, the clear path and gap is at 4,225, and I'm not too sure of how many gaps are under the market, but from what I'm looking at, it just looks like that gap is the one that it's going to target. So I mean, I'm going to have to assume that that's what the CPI is going to try to fill this Tuesday. All right, so yeah, I think basically we're going to probably pop, and if that's the case, and Monday closes as a doji, which is just flat like that, and then we get a big pop into CPI, then 225 would get us to about a 3% move. That would be pretty ginormous. And is it really worth taking that risk, holding positions overnight? Well, actually, it does show a 78-minute T-team squeeze, and we got the Bollinger Bands contracting in the volume here, and it could go either way. Obviously, it can roll over, right, to retest the 50-day moving average, or pop up 3% to fill that 4,225 gap. So at the end of the day, before the market closes, there is a possible trade where I'll be opening up uh, long calls and long puts into the CPI event, because that's a 3% move that could happen before the market opens. And I would be willing to risk about $50 on each position on the puts and the calls, because a 3% move is a pretty big move in those SPX. Okay, and then keep in mind, because the CPI data comes out Tuesday at 8:30 a.m. Eastern time, there's going to be little movement between Monday night all the way up until 8:29 a.m. Eastern time. So the action, if you're looking to see how price is moving on those SPX during the night, Monday night into Tuesday morning, don't expect too much until 8:30 a.m. Eastern time. That would be February the 14th, Valentine's Day. Okay, so that let's take a look at. I saw this bearish wolf wave on Netflix. Okay, and if the market does kind of sell off and ends up becoming a turnaround Tuesday, Monday could be a pretty nasty drop for a lot of the tech stocks, as a lot of uncertainty comes into the market. Another 6% drop to retest that 50-day moving average is probable. It depends on how the market opens on Monday, and then if the fear mongers continues to pump the narrative, then a gap fill here in Netflix is possible for the day of Monday. Now Tuesday, that I don't know. It could if because it's a binary event, we don't know if the price of Netflix is going to continue to roll over and end up filling 325 on Tuesday or Monday. So Monday could be just a doji day because of the indecision of the CPI. And then if CPI comes out negative and bears are in control, then you get the gap fill here at 325. So that's why if I'm going to go do an SPX position into CPI, then I'm going to have both the puts and the calls, because any wolf waves that are being present in the U.S. equities is going to give a little bit of a weighting into the way I'm trading today. Now, tomorrow can change, right? And especially at the end of the day, literally like 30 minutes to 10 minutes before the market closes on Monday, I could end up becoming bullish, right? Because the doji on the SPX and the E-minis could end up becoming a green doji, which is quite bullish. And but regardless of that, it's still binary. It's 50-50. No, that's by definition random, right? When you flip a coin. So it's still worthy to put in a put and a call in any case when you get into a binary situation that's going to produce a 3% upside downside move around an economic data report. Okay, so yeah, so there's a bearish wolf wave there. There's obviously gaps here. Like this could kick all the way down to 149 for Apple to fill the gap on 146. That could happen on Tuesday, right? We don't know what's going to happen. There's a BLT set up on Adobe, maybe a possible gap at 359, right? So and then all the way down to 348 to retest that 50-day moving average. So just a lot of broken charts here going into that binary event, and I don't want to be just jumping into any of these things. Here you got a green doji, which could end up pushing it back above 100 for Amazon, or again, if it opens slightly lower, then you got to move all the way down to the 50-day moving average to fill the gap at $90. Okay, and then let's take a look at Tesla quickly. Our beloved Tesla. See, so it doesn't always get right to that major moving averages, but it got, 90% there, up to 224. I called out it at 152, and then it just kept on moving higher, and then a retest of the 21-day moving average at 164. Gap fill, depending on the magnitude of this, how the market reacts to CPI, we could see a sell-off all the way down to 147 to fill that gap. So the momentum here on the volume, you can see it was just hugging up in the upper Bollinger Bands for quite some time. It did give a bit of a pause after it got extended here on Monday, June 30th, but then proceeded to move higher on that TGIF cycle, moving the price of Tesla all the way up to 227. Is that 227? That is 214 on February 9th, and then we're getting a pullback, and then if futures continues to trade red, it looks like we're going to go probably all the way down to 164, depending on CPI, right? CPI Monday, average move in Tesla is 5%. So if Tesla continues to make an average move again down 5% or 4.5, we've got to move to 186. And then if CPI comes out really nasty and the market doesn't like it, then you got maybe a 10% drop, which would instill a lot of fear in the market, because that's a 10%, 15% drop in literally 2 days in Tesla. All right, so moving on, I have posted in the Discord channel some interesting data sets, and let me pull that up right now. Where did I put it? Where did my data set go? All right, so the first one here is a complementary material that is going to help with with everyone's day trading. So if you're a day trader, I think one of the problems that a day trader has, especially with experience, is just the timing. And if you just collect and sit through the day and collect all the data points of how the markets move from the open to the close, and you collect enough data sets, at least about 2 weeks for each month of the year, okay, then what happens is you can start to model a general, or what I call here, a typical behavior of the market with respect to each day of the week, and with respect to a specific time frame, and I'm using here the 30-minute time frame. So Mondays, what I've done here is collected basically 1.5 years of data, and I've been doing this in the in TradeStation, and then I've exported that data set into an Excel spreadsheet, and then basically modeled the price action, or open and close, and then plotted that data set in terms of bearish price action, open, low, high, close, from the open all the way into the closing bell. And what I'm showing here is the result of all that data set after I've filtered out a series of noise, also filtered out holidays. There's a lot of filters that I had to go through, but this is the end result. And this is a data set that could be very valuable for those who are trading, day trading SPX, 0DTE, okay? It could also be useful for those who are trading general US equities, high beta equities, because if the market is moving up most likely those equities that are moving in tandem with the market are also going to move up with respect to beta, right? So here's Monday, and the typical price action on Monday, what it's showing here is that about 60% of the time, markets tend to open bearish. Okay, now the magnitude, you have to keep in mind here, this is giving you probabilities. So when it says 60%, it could be a minus 3% drop. It could be a minus 0.01% drop. Okay, it just shows negative. It doesn't give you the magnitude. Okay, so if right off the bat, if you're looking to trade zero DTE and you're going long calls, swinging from Friday into Monday, and there's no economic event over the weekend, most likely the probability of those positions that long calls will experience some sort of drawdown or decay is quite high in the first 30 minutes. So then when you look at the peak and trough, the optimal time to get into any position going long at the open would be at the point of inflection. So the point of inflection here on the right hand side, I've plotted an area, the area of what the histogram would look like, and then you can see the inflection point is right there between, obviously, 9 at 10 o'clock, right, or at 9:45. It could be at that period. So you want to wait around 15 minutes to even possibly the whole 30 minutes to kind of determine whether the market is going to continue selling off or reverse and try and then have the bulls show relative strength in the market, because that's typically a bull market. The bull market, in a real strong bull market, what happens is it dips in the morning, and then all of a sudden it just rallies all the way through the end of the day. That's a bull market. That's why the bull, when you go on a bull machine, it goes up and down, right? It can't just keep on moving up like a goat, right? It would have to mimic the behavior of a bull, one of those bull riding machines where it goes up and down, up and down. So here, that's kind of what it's showing. And then let's say you get into a position and you use like some sort of market internal, like the breadth or the cumulative ticks, or the advancing stock metric. You would try to determine the entry technically from 9:45 into 10 to 10:30. Okay, so 10:30, you can see that it tapers off quite significantly, and then after 10:30 all the way till 12:30, you've got pretty much decay. Okay, you're not really looking to get into any positions. You want to be out. Now, for U.S. equity stocks like Nvidia or Tesla, they could come out with news, and the momentum could carry the news of the momentum. The news would generate enough momentum to carry price higher with lower volume into into the end of the day, right? And that's why the SPX and then U.S. equities are a little bit different, because you could have other main drivers like news in the specific stock that can drive price higher with lower volume. Okay. If it drives price higher with higher volume, that's even better, right? To show that the price on the daily chart is going to continue with the uptrend. But then if the news comes out and is buying the rumor, selling the news type of thing, then obviously you want to pay attention to the volume to see if that's the case. Now, from 12:30 to 1:30, there's another sharp move in the histogram. Okay, and you can see that here on the area plot, and that could be like another scalping opportunity. So if you see a dip coming in at 12:30, at the end of the 12:30, at the end of the 12:30 candlestick, that would be the beginning of the 1 o'clock 30-minute candlestick. Then there's an opportunity for some algorithms to coordinate in tandem to push maybe the market from a negative to positive state, or even push it even higher. So the momentum here is basically being sustained all the way up until 1 o'clock, and then you get a sharp dip from 1 to 2:30, and then a big rip from 3 to 4. Now, zero DTE, the way that I'm trading is that because there's so much premium that is being baked into those contracts from the open, right? And a lot of that premium gets taken away in the first 30 minutes of the day. Okay, and then you get maybe like an hour or two to trade from 10, and then another opportunity to trade at 1. But then when time moves forward and you get around to 3 to 4 o'clock, the premiums are pretty much exhausted. So like a regular contract would be like here at 10 o'clock, maybe your contract would be trading at 3, and then now here at 3 o'clock, it's trading at like 70 cents or like 50 cents. And at that time, the price action of the SPX, because it's a 4-digit underlying, it moves those premiums pretty much with a beta of almost like 2. So every 0.01%, 0.1% move or 0.05% move in the SPX would translate to almost like a 25 to 50% move, approximately. I can't remember the top of my head, but the beta is quite high relative to the DK. Okay, that is ideal. Here, when you're trading at the open, the premium is quite high, which means that the DK with respect to time is much greater, right? So then there's definitely a disadvantage in holding those positions from the open all the way into the close. Now, sometimes once in a while, maybe like 5% of the time, there will be a period where it drops significantly lower, and if you bought at the low of the day and you hold 6.5 hours, then it could end up becoming a pretty profitable trade. But that doesn't happen all the time, right? So you have a disadvantage trading and holding at the open because of the high premium and then also the amount of time that is left in the day. And you can see here clearly from 10 after 10, you got pretty much momentum that is less than ideal, right? You need momentum in order for those premiums to appreciate significantly so that you can make a profit. So from 10 all the way up until lunch, you get into a contract for like $2, and then by lunchtime it's probably maybe like $1.50, and you pretty much did nothing during that period. So the whole point here is just trying to catch those day trades at time specific periods of the day. So wherever the inflection point is, so around 9:45 here and then 2:45. So I did that also for Tuesday, and you can see that Tuesday, you have Monday that opens up not as bearish as Monday, but you do get a little bit of a dip, and then you get a sharp change in gradient. That's where you get the maximum amount of momentum, where it goes from negative to positive, and then you get a bit of a pullback, or maybe momentum continues to carry the market higher, and another push all the way up until 12 o'clock, where it tapers off and goes, and then you get some bearish action going into 2 to 2:30, and then another sharp gradient. So if you're going into puts would be, if you get like for example, a bearish wolf wave that starts to form at 1:30, then putting on a put position from 1:30 to 2 to 2:30 would be ideal, right? Because that's where the market tends to show weakness, and then closing that position before the inflection point where it transitions from bullish to bearish, bearish to bullish. That's, obviously you don't want to hold those puts all the way into the end of the day, hoping that this data set is going to help improve your put position. Now, of course, if the news continues to be bearish and the market is pricing in different news. I mean, already we've had inflation that's being priced in. We're getting some other news about some balloons from China. You know, whatever you think the market is going to react to sharply. I mean, from what I see here, I think the market is going to react very sharply. In fact, binary into Tuesday. So if I had to use this on CPI data, I mean, I would I would I mean, because it's binary, none of this data really matters. Uh, and then when you look at the data set toward the end of the day, Tuesday, it doesn't look like opening positions in the last hour or 30 minutes makes the most sense, depending on how bearish the market is. But here you can see that you get a bit of a sharp transition from 2:30 to 3 o'clock. And then that could be a quick day trade for maybe like a 50 to 200% move, maybe 500% move. But then holding those positions into the end of the day, the probability is against you. Now, you wouldn't use this data set as a holy grail. You would use these data sets to strategize your timing with respect to how the market opens per day, right? You wouldn't, you would just use this as a guide. And actually what you can do is you can just use the two data sets that I provided here on Monday and Tuesday to see how accurate the models that I've presented here fit with the general market conditions. Okay, so it'll be interesting to see, but this is definitely what I'm using for my SPX and 0DTE challenge, and it helps me understand how I want to be trading into as the account grows. So like I mentioned before, once the account reaches around 2,500, 3,000, I'll be looking to trade more of these inflection points in time. With that would mean the trading frequency would increase from 1 to maybe from 2 to 3. At the present moment, because the current challenge, we're at about $1,000 from 400. I still want to grow that account so I have enough ammunition in case there's a period where the market goes nuts, and I want to enter into a 0DT that has the highest probability of producing like a 15 to 20x return. And that would be at the end of the day. But based on my research, a lot of the data sets shows that there's a lot of power hour rallies. And when they do happen, they happen toward the end of the day. And then that's most of the time. And what the highest probability of having that momentum come in at the end of the day, obviously that's why it's the phrase is power hour rally. You would still need to use a supplemental indicator like the COMTIX or some sort of advanced declining tool to determine whether the market gets into an overbought condition literally into the close. Now going to the last part of the presentation, which is the 0DTE. So we started this challenge on January 10th, and I'm 100% focused on just trading these until the account reaches 10,000. Based on the number of trades from the beginning of January 10th, we have severely underperformed the initial assumption, which is basically reaching 10K in about 7 trades. If you've been in the trades that I have posted, actually about 5 of those trades produced about $3,000 to $4,000. So in theory, if I had to think about where we are and we took every trade into the end of the day worthless, we should be at around $6,000. At the moment, we're at 1,100, which is not too bad, but we're 90% away from the 10K, right? Or actually probably 93% away. So we got a lot of work to do, and the plan here, because Monday, if we pull up that chart, so using this data set, okay, now because my account is at 1,100, I want to have this account up to around 2,500, 3,000 before I start taking some of these trades at the open, right? So if the market opens lower, there's going to be an opportunity to trade that inflection point here from 9:45 into 10 to 10:30. That would be a day trade. The reason why I don't want to be taking those trades with a smaller account is because the amount of premium that I have to pay is almost double to three times the amount that I would have to I paid for at 3 to 4. So if you look through the data set and look at all the trades that I've been taking, almost 80% of the trades have been opened at the end of the day, where the average cost per contract is about $1. Now, if I open those positions at 9:45, those contracts are, I know that I can push my delta lower to the point where I can get those contracts to $1, but the decay rate is so high that it doesn't make the most sense. I would be looking to get into positions around 2 to 250, which means that it would require me to have a little bit more capital just in case I don't get those get that trade, right? Because the problem with this data set here is that you have timing, but what you don't have is the magnitude, like how high is the market going to rip all the way up until 10 o'clock. Okay, it could be a 40% return, it could be a 200% return, it could be a 500% return, it could be like a 2,000% return. Nobody knows. So that's why the SPX challenge is asymmetric, meaning that we take small risk such that if it does go to zero, it doesn't really affect the net balance, right? So if I take a position for like $50 to $100, and I'm in a position where that position can go from $1 to 25, 10 times if I take that trade and I don't win, you know, that adds up quite a bit. That adds up to about, say, like $1,000, right? But if one of those trades, based on some of the using the timing and then also the behavior of the market, if one or two of those trades pay out 5 to 10x, that's quite a big return for such a small position, especially if you get into a contract that's like 50 cents to 30 cents. And that's the whole point of the whole SPX, is trying to get into that position where we take a very, very tiny risk and produce returns all the way into the end of the day that produce about 15 to 20, 30, 40, 50x. Okay? All right, so I hope that helps. We're kind of still struggling in the 10K, and the plan here is just to continue maybe another. So we did do, there was a duplicate open up last week. So I think we're at around 23. So I'll give it maybe up to 30. I'm because the way that I'm approaching the SPX trades now with specific setups, I'm hoping that either the CPI data would push this account up to about 3,000, 4,000. If I risk, so right now my account is at around 1,100. If I risk $100, that's $50 per contract on the puts and calls. Those could end up returning about $3,000, $4,000 if we do get that 3% move. So that's what I'm thinking of doing. I don't know if I'm really going to go into trading. Like I see there's a 78-minute TTM squeeze in the E-minis, and it could end up rolling over, right? CPI, we don't know if the CPI is going to roll this thing down to the 50-day moving average or pop it up to fill the gap at 4,225. But in my opinion, even actually, if I'm gonna open up a strangle into CPI, I would probably try to catch the low of the day on the contracts for the 14th. Okay, so the 14th at 3% move. Let's take a look at those contracts. So the 14th, oh man, that's a pretty wide move. So the idea here is that you're gonna get those contracts cheaper as the market is pulling back. So 4,200. Whew. Yeah. You know, I'm looking at the February 14th, $4,220 calls, and they're trading at $2.30. That's where the gap is. Now, if the gap fills at 4,225, which could happen at the end of the day or at the open, we don't know. We would have to get into the 50-cent contracts. That's at 4,260. Yeah, it's hard. It's hard to say like how this is going to play out. There's a lot of decay that can still enter in, but if the market moves just a little bit and flat, then those contracts that are trading at 50 cents could end up closing at $1.60 into Tuesday, closing into Monday, and then a binary event would move the market all up to 4,225, which will make those contracts, the 4,260 contracts, about $20. So that's something to think about. We got lots of time to see how this market reacts, and then if the market does end up selling off huge, dropping 3%, then wow, you got to go all the way down to 3,000. I mean, the let's go to the SPX. I mean, the 50, yeah, that's like a pretty crazy move. Well, it's only 2.3%. Down to 3,971. Yeah, like you don't really see the SPX gapping down 2%, right? It would still require it to, I mean, this gap right here is just like a percent. So, and then maybe you get, yeah, that one's a bit tough. So I will just let time do its thing first. We don't know what this candle is going to look like at around midnight. Yeah, I think better just stick with the plan for 0DT and then determine whether the risk of taking a straddle into Tuesday is worth it. All right, thank you very much, and I hope this video helps.